Well, stocks gain on hopes of milder consumer inflation in the US, IT and FMCG gain, while realty and utilities drag. Mid-caps underperform.
The consumer price inflation rose 6.5% in January, which was well ahead of expectations of near 6%, raising the risks of a further rate hike by the Reserve Bank of India. Realty stocks fall on fears of higher cost and lower demand.
And Nykaa slips following a dip in profitability. All cargo slumps as lower freight rates dent earnings, and RHI Magnesita slides on a sharp decline in margins.
The Supreme Court suggests setting up an expert panel to review investor protection rules in light of the Adani share crash. The government accepts but wants information to be shared only in a sealed cover with judges.
Hello and welcome. Good afternoon. You're watching us here on Halftime Report. I'm Mangalam Malu. With me are Sonia Shenoy as well as Ekta Batra. We'll soon be joined by Lata as well. But just keep an eye out on the markets. It's looking like a good afternoon so far. We're virtually at the high point of trade, 17,880 on the Nifty, a century, and that's largely on account of three factors. One, we have the IT index that's batting for the bulls. Secondly, Reliance, by virtue of its weight on the index, is doing, its heavy lifting right now. Reliance has moved to the high point of trade. And the third one, a late bloomer in today's trading session, has been ITC. Again, a heavy weight on the index. So IT, ITC, as well as Reliance contributing to all the gains on the index today, in absence of some performance coming in from the Nifty Bank, which is still mildly in the green, as against 0.6% that the Nifty is. The mid-cap index mildly in the red.
Okay, so it's a good Valentine's morning, it seems, for at least the bulls. After all that back and forth in the last many days, today, I guess the market is, holding fort. And so many numbers, right? So many nifty companies coming out with earnings. Later in the day, of course, there's ONGC, there's Grasim, there's Eicher Motors, Apollo Hospitals as well. So a lot of data coming through. And on the macro front too, lots to watch out for.
Yes, absolutely, Sonia. And, I'm glad that it's the last day of the earnings season. Tomorrow, there are no big earnings expected. So that's the big headline, but nonetheless,
I have a couple of big earnings to go even after the earnings season, because for companies which report calendar earnings, say something like Nestle, they get a longer leeway, so they will be reporting even after the earnings season.
But we leave that to you.
That's your problem, not ours.
Yeah,
that's a me problem.
Numbers coming through and flood of earning calls coming through, but nonetheless, the other big eye or the other big Q is definitely on the macros. We had the India Jan CPI, which inched up to a 3-month high. We have food inflation, which is sticky, core inflation, which has been sticky, and we have the US Jan CPI data, which is due this evening. So that continues to be the big focus. We have the WPI data for the month of January, which is going to hit the screens anytime now. So we will be watching out for that. A lot of macro data in focus, but besides that, a lot of earnings as well. Eicher, Apollo Hospitals, ONGC, Grasim, and we have a lot of stocks to discuss. In fact, let's, while we wait for the WPI data, we do have Lata in the studio with us. She's going to take us through the data and what she thinks of it. But before that, we have Nykaa, which is in focus. It's under pressure on the back of its Q3 numbers. Mangalam, tell us more. No respite for the stock.
No respite for the stock. One would have thought that 33% growth that the company has shown would keep the frayed nerves at bay. But no, it's the composition of this growth and its resultant impact on the margins that has brokerages worried. The stock is at the low point of trade. I mean, if you just take a look at the brokerage commentary, Goldman Sachs says that while they're positively surprised by the acceleration that they've seen in fashion growth, they are surprised negatively by the beauty and personal care segment. They are neutral ratings on the stock with a target price of almost 200. The other brokerage house, which has a similar target price, is Jefferies. They have a buy rating. They say that the GMV growth was led by fashion and others, which is lower in contribution in the overall revenue, whereas beauty and personal care was lower in terms of their expectations as compared to growth the same time last year because of a high base and the shift in festive season. And their gross margins were lower than expectations because of inferior mix, discounting and down trading. Then we have Nuvama, the erstwhile Edelweiss. They've lowered their EBITDA target by 8%. They've effected a sharp cut in their target price from 251 to 195. And that's largely on account of increase in cost of capital assumption. So the minute you increase the cost of capital assumption that you have, your discounting factor increases, and as a result of which the terminal value and the valuations that you ascribe to future cash flows decreases as well, and that's resulted in a cut in their target price. So all these factors are impacting Nykaa right now.
Okay, well, the other one that's really getting hit right now is All Cargo Logistics. It slipped in trade after reporting a very weak set of numbers. Mangalam, what went wrong there?
Well, a bunch of things. One, their core business, which is the ocean freight, transport business, has been affected by lower freight rates. They haven't seen any volume decline, but the reported numbers, there has been a 27% decline in their revenue, a 47% dip in their EBITDA, and a net profit compression of 62%. Even quarter on quarter, the margins have compressed by about 160 basis points. The net profit has fallen by about 35%. And if you take a look at their international segment, international supply segment, there has been a revenue decline of 29%, and operating profits have been down by about 40%. Now, a large part of the reported numbers are also overstated on the downside, as the management told us, is because of the demerger that they've affected. So if you adjust for that, the revenue decline would be about 20%. The EBITDA decline would be about 30% as against 47%, but it is a decline nevertheless. So we've seen an improvement from the lows on the stock price because of them having gained market share and not seen a volume decline. But then again, the fact that ocean freight prices are lower has led the stock price to be lower by about 13% as we speak. Up 7% from the lows, but still down 13%.
Okay, all right. So that's on all cargo logistics. Steep fall for that particular counter, down over 13%. RHI Magnista is the other one which is under pressure. It's down over 7% at this point in time. Again, reacting to its quarterly numbers. Nigel's been tracking this. He joins in to tell us more.
Well, two factors that are played out that's put pressure on RHI Magnista. One is in terms of their numbers. So yes, on the top line, there was a good growth of close to around 20%. The problem is that the EBITDA number got compressed by close to 13%, which led margins to come down to around 14% odd. A weaker operational performance led to a net profit as well, seeing a sharp compression. Now, if we're looking at the margins of the last few quarters, well, it's declined from around 20-22% all the way to around 14%. Not just that, this is the lowest margins they've reported all the way since September 2020 quarter. So that was the disappointment in terms of operational performance. The second factor is the company has said that they've taken an approval to raise equity to the tune of close to 1,500 crore rupees. Now, the street is disappointed with that because that's a large dilution. They had a couple of inorganic acquisitions that they've done, and the street was expecting them to fund it via debt. But raising equity will be a bit of an overhang, and that's why the stock was down. Weak operational performance as well as an overhang in terms of raising some equity. Back to you.
Okay, thanks a lot for that. That's RHI Magnesta. Let's slip into a quick break. When we come back, we'll get you more on the markets. A lot of stock-specific action, a big market voice, and some corporates going as well. So keep it with CNBC-TV18. Welcome back to Halftime Report on CNBC-TV18. Well, the market is looking pretty good at the moment. The Nifty is now up 124 odd points, and the Sensex is seeing a gain of almost 500 points. The stock that's reacting very well to both its numbers as well as the management commentary is Glenmark Pharma. Just pull it up for you, 4% higher now on that stock. Ekta, what's the key takeaway from what you heard?
Well, it is actually quite a development for Glenmark Pharma to be reacting positively to its numbers 2 days in a row. We haven't seen that happen post its quarterly numbers for a couple of quarters now. So this is definitely positive. The street obviously likes the commentary from the management as well. Now, in terms of guidance, the company did say for FY23, the guidance is a revenue growth of 6 to 8%, EBITDA, which is similar levels as FY22. Now, the company says that Q4 should also possibly see a turnover of around 3,400 crores. That is the asking rate to reach that 6% growth. They're confident of doing that. Margin has hit 18% in the last couple of quarters, so they're striving to achieve those 18-19 exit run rate margins for FY23 as well. So they are hoping to reach those targets. They keep, in terms of the US sales, Q3 FY23 hit $102.3 million. The company says that US sales should possibly be around this $100 million mark on a quarterly run rate going forward as well, which is definitely a positive, because then the street would anticipate maybe a scale up slowly in the US sales. Now, Monroe has an official action status. Goa has a warning letter. Buddy has an import alert. The company says they're working on remediation for Monroe and other plants such as Buddy. They are doing their best in terms of remediation. They don't see the US business being impacted because of these US FTA issues at this point. Net debt, 2,615 odd crores. They're confident on reducing net debt. Debt reduction will be via internal accruals. FY24, they're estimating 10 to 12% growth, margins of around 19%. Don't need to divest further in terms of the India business. We did speak to the management. Listen in to what they had to say.
As far as our overall guidance is concerned, if you see over the last couple of quarters, consistently we have had a turnover of about 3,400, around thereabouts. So Q4 also we should be close to that or a little higher than that. As well as our margins, while the first quarter was a little low, the second 2 quarters we come out very close to the 18% or higher. And last quarter also we did about 17.91. So I think we believe that Q4 we seeing some good opportunities. We are actually working on the remediation side, both at the Monroe plant as well as our India sites, including Baddi as well. So I think last quarter also there were quite a few of remediation effort done. Even the next quarter is going on. So I think we'll take it as it comes. But as far as we are concerned, we are doing our best in terms of the remediation, I think. And with the kind of work we are doing on the margin side and lower cost across some of the line items, we feel between the 19 to 20% is something that we should be working towards. And obviously, this should help us to pare down some of our debt. Even if you look at it, last quarter, we've done about 100 crores in our net debt. So while we may not put a number to that, we definitely are confident we'll reduce it further.
All right, so that is the management of Glenmark. Just don't lose sight of the market. Just 5 points away from, in fact, as we speak, 2 points away. And if we hold on for maybe a second or so, we will see the Nifty hit that 17,900 mark once again. 17,899 is where we are at right now. The last bit of an uptick has been led by the Nifty Bank, which has been an erstwhile underperformer, but now has picked up some pace. The Nifty Bank too, sitting with 3 digits in terms of gains. We come back and get talking about earnings. The management of IRB Infra joins in to discuss their third quarter numbers.
Welcome back. Well, after a long wait, we do have the January WPI data, which is coming at around 4.73%. This compares to 4.95% on a month-on-month basis. So there's definitely softness which has emerged on the WPI data for January, contrary to what we saw in the CPI data. Lata is here with more details. Lata, it is a 24-month low which is coming.
Yes, and that is to be expected because these are year ago very high numbers over which these numbers were expected to come. Remember, last year, even leading to the Ukraine war, we had seen a lot of metal price increase and oil price increase in Jan-Feb itself. And then, of course, Ukraine pushed everything up. But because it's coming off a high base, the numbers were expected to come lower. But I just want to point out before I come to the inflation number itself that the November inflation number has been revised up rather sharply, from 5.85 to 6.12. So that's almost a 30 basis point increase. Usually, this is unusual, such a sharp increase. But be that as it may, the number for January itself at 4.73 is not at all alarming. It's lower than 4.95 in December. One of the news agencies had a poll of 4.6. So you may whine a little saying that it is about 13 basis points more than the poll, but that's not saying much. What the WPI number brings home is that the same food problem is there in the WPI as well. The food index is up 0.5% on the month. Remember, the CPI was 2.6% on the month. So that's a bit shocking. But if you looked at, there is a 2.95%, sorry. There is a 2.95% food inflation higher. So that looks a little scary. I think that 0.5 is some other index. Food inflation WPI is 2.95 up on the month, and that looks like it is attesting to what we saw in the CPI as well. Manufactured products inflation has fallen to 2.99. That's almost 3% compared to 3.37 in December. That's a positive. Fuel inflation also lower, 15.15 compared to 18% in December. So overall, there has been a reduction in YOY terms in manufactured products and in fuel. Only in food inflation we are seeing a rise. So quite clearly that has to be attributed to cereals. Cereals index, this one says, is up 1.7% on the month. Remember in CPI, the cereals index was 2.6%. I mean, it looks a little lower. Perhaps there are always times when retail inflation is a little more because of specific pockets of availability. But this 1.7% is an ugly number. Short point, WPI overall, not to worry. Worrisome point is food inflation and cereals inflation. It is merely attesting what we saw in the CPI.
Just a quick follow-up, Lata. Is this WPI data going to be seen in context of what happened with the CPI data now? That despite WPI maybe coming higher than what the street was estimating at around 4.6%, it's at least better than what the CPI data reported.
Well, actually, the WPI is a slightly less important number because the policy is mandated to look at CPI. So, to that extent, the MPC can't shake off the fact that it is going into a meeting with the inflation number higher than their mandate. So, that is what is going to hurt them. Therefore, I mean, I don't see the lower WPI having a very, very big impact on the MPC. For what it is worth, at the moment, the bond yields have softened by about 1 basis point. But that's neither here nor there. I think the big takeaway is that cereals inflation has come in high. So it is kind of giving a proof that the CPI number was not all that incorrect.
Okay, so we can deal with one shock, which is a CPI number. 2 shocks we are not okay with, right? So, all right. Thanks a lot, Lata, for joining in and explaining to us. That's the January WPI inflation number. But let's move on now. We have a corporate joining in. IRB Infrastructure reported an inline set of numbers for Q3. The profit after tax nearly doubled, while toll collections also rose year on year. The company has also received an appointment date from Uttar Pradesh Expressways Industrial Development Authority for the Ganga Expressway project. To discuss details of this and the way forward, Tushar Kavedia, the CFO at IRB Infra, joins us now. Tushar, thanks a lot for joining in. You know, if you put together what you've done in 9 months so far, the revenue growth has been just about 7% at about 5,000 odd crores. This compares to 4,670 crores same time last year. Of course, we'll talk about the construction and the BOT segment separately, but overall, what is the expectation in terms of the year-end figure on the back of the 7% growth in 9 months of the year? Do you think you can do double digits by the end of FY23? And what's the projection for FY24?
Sure. So, yes, what we are seeing for the comparable number with the last year, the difference is last year the construction revenue had a GST impact due to the gross revenue being reported, including GST. Now, with there's a gap. So, from this year, we have taken it as a net revenue. So, as per our plan, the execution for this year is going post the achievement of Ganga COD is on track, and what we believe for this year end, the construction revenue should end up somewhere between 44 to 45 billion with the pace what we are seeing in the execution in the projects, which includes the Ganga Expressway and the other BOT project in Bengal and the HAM projects as well. So for next year, what we think is the construction revenue should at least be so the construction revenue should see a jump of at least 10 to 15%, which should be somewhere around 5,000 odd crores. And on a toll front, as we have already seen a good growth in the last 9 months, for next year, at least 10 to 12% growth in the toll collections also can be envisaged with traffic growth of at around 5 to 6% and inflation around 5 odd percent.
All right, 10% toll growth next year with 5% traffic growth, and 5% would be the toll price growth, with EPC and O&M business being about 4,400 to 4,500 crores this year, around double-digit growth, closer to 5,000 crores next year. So we will, keep that on our mind, and analysts will pencil that in as well. But I wanted to know about your debt levels. Currently, what do they stand at? How much have you repaid? What's your debt repayment status at?
Yeah, sure. So on debt, as we have repaid our substantial debt on the standalone in the last year itself, the net debt to equity is at 0.8, and which will over period will go further down when we are having a repayment schedule happening on a timely basis. The repayment is happening on a timely basis in the coming quarters as well. So today the net debt is at say 10,150 crores on a console basis, and on a standalone basis, the net debt would be somewhere around 1,500 crores.
Okay. Just wanted to come back to your toll revenues. You have guided for around 10% in the next fiscal, but can you just tell us what some of your key projects have performed like for 9 months, which is say Mumbai, Pune, Ahmedabad, Vadodara, and what are we expecting in terms of these key projects or the toll collection from them going into FY24?
So sure, on Mumbai Pune, what we have seen in 9 months, the overall toll collection was 20% growth on YOY basis. This is purely based on the traffic. Whereas in Ahmedabad, Vadodara, we have seen a 24% kind of growth in last 9 months. That is from April to December, and there was a tariff hike in Ahmedabad, Vadodara that was close to 10%, which happened on April 22, and what we believe the quarter or maybe for the next quarter also, that is the fourth quarter, the number should be in line with what we have achieved in the third quarter, close to 550 crores, and that is the number what we are projecting for the fourth quarter as well.
Okay, so this 5,000 crores construction revenue number that you've given us for FY24, is this penciling in the Ganga Expressway project? Can you tell us how much is the revenue contribution from that, and what are you looking at in terms of financing, timelines, etc.?
Yeah, sure. So for Ganga, yes, definitely we have received the appointed date in the third quarter of this fiscal, and this project will contribute to the construction revenue in the next year as well. The project will at least contribute somewhere around 500 to 600 crores every quarter because the project needs to be executed in next 2.5 years. So considering the balance order book for this project, we will be executing somewhere close to 500 to 600 crores for this for the Ganga Expressway. On the financial closure, the project has already achieved the financial closure. So disbursement will happen as per the schedule and the execution. Here we just want to inform that we have a GIC being participating at 49% for this project. So they will continue their investments and the ratio of 51 with IRB and 49 with GIC.
Right. On your EPC business, just wanted to know what the order inflows have been like in this quarter. What can we expect in the next financial year? What does your current order book stand at? And on your InvITs, what are the assets that you've earmarked for transfer into the InvITs next year?
So if you see, our order book today stands at somewhere around 19,000 crores, which includes 8,000 crores towards EPC and balance towards the O&M. From the execution, so with the wins today in this quarter, there are many assets are under bidding pipeline, and we are bidding for the same. We haven't bagged any one project in this quarter, but however, there was a delay from the bidding side, from the authority side as well, and there will be a good traction being seen on the bidding side in the coming months. We expect at least to grow our order book from this available pipeline somewhere around 6,000 to 8,000 crores, which will be at least 20% higher than what we have consumed this year. So that is our expectations, and with the pipeline available, we are quite confident to achieve that kind of order book growth.
All right, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from IRB Infra. Confident in terms of toll collection as well as in terms of the construction revenue. The key flashes on your screen. The stock down around 1.5%. Need to take a break, but on the other side, we have a special and exclusive conversation with Mark Mobius, founder at Mobius Capital Partners. Stay tuned.
Welcome back. You're watching us here on Halftime Report, and it's time for an extremely special and an exclusive conversation that we're having with Mark Mobius, who's the founder at Mobius Capital Partners, joining us now. Mark, always a pleasure speaking with you, and it's the first time that you're speaking to us post the announcement of the union budget as well. So just wanted your thoughts on where you are positioned on India right now. You have been a long-term India lover. A lot has happened. We've seen, the budget being announced, the markets being in a bit of a range. At the same time, the Adani crisis unfolding, so to say, as well. With all these things, what are your thoughts?
Well, we're still very bullish on India. As you know, I've been a fan of India for quite a long time, but that excitement that I have about India has actually increased. As a matter of fact, my partner, Carlos Hardenberger, is in India right now, looking at companies and looking for bargains. And the Adani thing is not really very important from our point of view in terms of looking at India, because first of all, that situation was not a very serious problem in terms of corporate governance. Yes, they could have done a better job in corporate governance, but generally speaking, a lot of the information that was revealed by Hindenburg was pretty well known by the market. So, in addition, the fact that it's such a big company gave the world a notice that India has large companies and companies that are able to raise an incredible amount of capital. So, on the one side, it's quite a positive message for India, although maybe not the right one in the long term, but in the short term, I think it's been a good one. But it also gives us a warning that we've got to look at companies that have too much debt. And in our case, we will not touch a company that has a debt equity of over 50%. So we're still very positive on India. We're finding lots of good bargains.
Okay. Mark, hi, welcome to the show. In that context then, what is your allocation towards India at this point in time, vis-a-vis, say, a quarter ago? And if you are looking at the mandate of no debt, what might your sector allocation be currently within the Indian market?
Yes, right now in our funds, the largest allocation is Taiwan, but we are actually reducing that in favor of India. So you're going to see India coming up. India is the second largest allocation in our portfolio. And the strategy, as I said, is to look for companies with a high return on capital, over 20%, and a debt equity of less than 50%, and of course, earnings growth. And we're finding the best opportunities in software companies to begin with, and in companies that are in the medical area, particularly medical testing, and finally in companies that do products that can contribute to the infrastructure requirements of India. Because, as you know, India is going to be accelerating the infrastructure spending, and we want to be participating in that.
Okay, that's interesting. I want to take that discussion forward on software companies. Mark, a pleasure having you on the show. I noticed that in your sectoral breakdown, you've actually reduced your weightage on IT. It's now at a little over 50% compared to, I think, about 58% in early Jan. Is that a fair way to look at it, that you're perhaps a bit cautious on the Indian tech companies after what's happened? And of course, there is the possibility of an impending recession globally as well. How would you approach IT now in the scheme of things?
No, we're still very excited about IT in India. And we, of course, the portfolio weightings will vary according to the prices of the companies. If the prices go down, of course, the allocation looks like it's being reduced. But in fact, we are continuing to hold our IT companies and look for better opportunities. Further down the line, I believe that India is going to become an important producer of semiconductors, and all the companies related to semiconductors will be interesting. Semiconductor testing, semiconductor materials, et cetera, but that's further down the line. Right now, it's really software.
I'm looking at the three macros that you spoke about: software, healthcare, diagnostics, as well as stocks related to infra plays. And this ties in with your three largest individual stock holdings as well. You have Persistent Systems, you have Metropolis Labs, and you have Apollo Tubes as well. Metropolis, we had the management join us yesterday, and they said that, while their COVID testing was down 88% year on year, X of all the COVID-related and non-linear businesses, they are targeting 15% growth going forward, with margins being maintained as well. So after the dip that you've seen, does it tempt you to buy a little more of Metropolis?
Yes, it does. It's really interesting to note that many people were looking at the COVID testing and thinking, oh, that's everything. And therefore, when that's over, Metropolis and other testing companies will be in trouble. And of course, that was not true. And you can see how the stock has been recovering as a result of people realizing that, hey, these testing companies were not only about COVID, but about many other things. And I believe going forward, that incredible growth in earnings will justify us buying more of Metropolis and looking at other such opportunities.
Okay. Well, Mark, we have you at an opportune time because we do have the January CPI data from the US, which is out this evening. And the street is anticipating that if it's a flat number on a month-on-month basis, then there could be some amount of trepidation which could emerge in the US markets. What is your reading in terms of how important this piece of data is? What are you expecting from the Fed henceforth?
Well, first of all, I think it's important to note that the interest rate continuum and also inflation numbers really do not correlate very highly with the stock market. Sometimes interest rates go up, inflation goes up, and the market does well. And sometimes the opposite. Of course, recently, we've seen the opposite happening. So that's the first thing. At the end of the day, the Fed is really in trouble because on the one side, with an election coming up, and must remember that the Fed is a political organization. The people that are appointed to the Fed have political ties. So they don't want the current administration to be in trouble with a bad economy. And therefore, they're going to be very, very cautious about raising interest rates too aggressively. Of course, they want to get down to that 2% number, but they're far away from that. And they're just hoping that that CPI number at least moves sideways and they can have time until the election to keep the economy on even keel.
But do you get a sense, Mark, that this could be a year of subpar returns for global equities, including emerging markets like India? I ask that because we are still in a rate hiking cycle. I mean, no one knows which way it's going to go. And, you have a growth slowdown coming through as well, an impending recession. At such a time, do you think equities could take a back seat, perhaps more money moving into other asset classes like gold, debt, etc.? And what's your own prognosis on how things could shape up for emerging markets as well?
Well, as you know, gold is doing quite well because of the buying by China and Russia, probably in anticipation of trying to establish another currency that would be competing with the U.S. as a reserve currency. But at the end of the day, it's equities, and now it's emerging markets equities. As you know, emerging markets are now beginning to outperform the U.S. market and developed markets generally. And we believe that's going to continue going forward. More and more people are beginning to realize these emerging countries like India are doing very, very well. They're growing at an incredible pace. And because of the Ukraine war, they're getting Russian oil and gas cheap. And of course, that's very positive for many of these countries, particularly India, who are importing their fuel and energy. So I think it's the year of emerging markets, and a lot of investors in America who are scared about the U.S. market are beginning to realize that.
What do you see as the potential risk to equities around the world and emerging markets, India in particular? And were those risks to play out, what is the potential downside that you foresee?
Well, the big risk in Asia, in East Asia, you're talking about Taiwan, Korea, and those countries, is something happening in Taiwan with China trying to take over Taiwan in a military effort. That is a huge, huge risk. I'm not predicting that something will happen tomorrow, but that is a big risk. And of course, in that case, India begins to look very, very safe. It's far away from that kind of conflict. And in fact, India would probably benefit from such an unfortunate situation. So that's one of the big problems facing us. And then globally, another problem is the entire internet global telecommunications system. A breakdown as a result of hackers and a result of crypto hacking taking place could be a real problem going forward. But that's a global phenomenon that would affect everyone.
Okay, Mark, just a quick question from my end, and the last one. The Adani issue, you said it's not that critical from a larger context, but are you worried about a spillover that it could have on the banking and financial space? Is that something which could be a concern?
Oh, definitely. It's something of great concern. And that's the reason why we've been very cautious about banking stocks generally, because we believe that probably a lot of things on their books that would create, bad numbers for the banks. But at the end of the day, it all depends on how fast Adani can move up and raise capital. At the end of the day, they have to raise equity in order to help pay off those debts, those bank debts.
Okay. Well, Mark, it was a pleasure speaking with you. Thank you so much for joining us. And it's great to hear that you're still very bullish on India despite all the challenges that we've seen. It's music to the ears of Indian investors for sure. Hope to speak to you again very soon.
Thank you.
All right, that's Mark Mobius saying that they're looking for good bargains in India, and software and medical testing is something that they are excited about. In fact, they're quite excited about tech companies and the fall that they've seen recently, looking to buy over there. Let's slip into a short break. On the other side, a commodity segment will bring you excerpts of a conversation with Ranjit Rath, the chairman and MD of Oil India. Stay tuned.
Welcome back. Well, for the markets, it's holding steady. The mid-caps are underperforming. We do have some source-based information on your screen, just to take note of it. Sources to CNBC-TV18 have indicated at this point in time that the IT department is conducting a survey action at the BBC offices in New Delhi and Mumbai, and this is with regards to alleged irregularities and income concealment. So this is what sources are indicating to CNBC-TV18. We'll get you more visuals, more details on this particular story, but as of now, this is what we are picking up. Back to the markets, just want to point out one particular stock which we haven't really addressed as of now. Newland Labs is reacting very well to its numbers. That stock is up around 10-odd%, so do watch out for that. Strong performance this quarter, and the stock is reacting well. But let's move on to commodities then. On the sidelines of the India Energy Week, which was held from Feb 6 to the 8th, Manisha Gupta, commodities editor, did interact with Ranjit Rath, who's the chairman and MD of Oil India, and spoke on a whole host of issues like volatility in crude prices, oil demand, and energy transition. She began by asking him about the opinion on windfall tax.
To me, windfall tax is something like revenue generation for government. And I'm sure government has a lot of fiscal balancing to be done. So considering the fact that the crude oil saw a jump, rather a massive jump in terms of pricing, so it's prerogative of government to levy and then convert that particular collection or contribution of oil and gas companies for social welfare.
How would you look at the year gone by, 2022, in sense of volatility in crude oil prices? How were your margins and profits because of that?
So in terms of profitability, Oil India remains profitable. We are part of the upstream segment of the hydrocarbon value chain. But one thing which I must tell you, that by virtue of being part of the hydrocarbon value chain in the upstream, say, we are aware of the fact that crude oil would always remain volatile. Now, the degree of volatility is what bothers us. Sometimes the degree of volatility helps us to have a strong revenue, and not very often we see a drop. But to me, what is more important is that this volatility creates an opportunity for us not only to make money, But making money is not the key. It is actually gives us a leverage to plow back that particular revenue in the upstream part of it, where exploration is our focus. It's a very subsurface driven, hugely risky venture. So this gives us a leverage to plow back the revenue into the exploration part.
The conversation about IEW clearly has been one towards fossil fuels, because that's not dying down. Clearly, everybody's been saying that the world oil demand has not peaked yet. But on the other side, there's such strong thrust on renewables, on green energy transition. How are you looking at both of these coexisting? How do you see investments being cut between two?
Transition is here to stay, and it is time that we have started thinking about transition. And as India per se, significant effort is already on to ensure that we create a renewable portfolio from a country point of view. Besides that, this current budget, which happened last week, has given tremendous amount of stress and thrust on the green part of it. So we could call it as a green budget. But from an Oil India point of view, we are a hydrocarbon company. So while we will protect our core of hydrocarbon exploration and production, we would also look at our alternative energy portfolio.
While we have seen this, and this is your word, you said the Indian fuel demand is unstoppable. Are you guys putting any number to that? What has been the growth since COVID? Are we back at pre-COVID levels? What is the kind of demand you're working with?
See, Indian energy basket is going to grow 2.5 times. That's one. The kind of refining capacity planning is on. That is why I say unstoppable. Third, India is actually offering a kind of destination called refining hub, because you have the oil fields on the western part of the country, and then the market on the eastern side, and with the coastline of India, you are actually on a vantage location. And while we say that refining is in the growth path, you must know that Oil India today is no more an E&P company. We have recently acquired Numaligarh refinery, and Numaligarh is going for a expansion from 3 million ton to 9 million ton. And we see strong return on that, for which we are actually running a cross-country pipeline of about 1600 kilometers from the eastern coast to Numaligarh. So we will actually have domestic crude and imported crude processed in Numaligarh and then cater to the mainland, and probably the look is possible.
Okay, that's Oil India. But in news just coming in, the Income Tax Department is conducting survey actions at the BBC offices across New Delhi and in Mumbai. Sources suggest that this is with respect to the alleged irregularities and the income concealment. More details awaited, and we'll bring you the updates as and when we get more information. Thanks for watching Halftime Report. With that, it's a wrap. Business Lunch will take all the action ahead.